In this video, traders, we're going to look at trading Tesla options if we've got a bearish thesis. Some ideas. Stay tuned. Hey traders, warm welcome to you. Okay, so let's have a look at trading options and let's use Tesla as an example. So let's make the assumption for hypothetical purposes, for example, that we're bearish on Tesla. We think Elon Musk is a clown. We think he's not going to be able to get financing. We think he's not going to be able to produce the cars he wants. We think he's unstable. And by the way, I don't personally think these things, but we're just looking at it from, let's imagine we were bearish and those are the ideas we had, whatever they were. We're aggressively, we think we're going to be heavily short on it, want to make money from Tesla failing and failing pretty quick. How do we do that? Now, obviously, we could be naked short. If we're naked short, we've got to potentially sit through the stock rallying and we could end up with a loss. So other way of doing it is trading options. We've got two ways to trade options. We can buy a put. Now, a put option is the right to sell something at a specific right, but not the obligation to sell something at a specific strike price at a specific point in time in future. So if we picked a $20 put option, it's the December $20 put option. We've got the right to sell that stock at $20 at the December expiry, and that may be December 21st, whatever it may be. So we need to see that stock below $20 for us to get any value from that. If it's above that, we're going to lose money. So that's a put option, and those are the things we probably want to do. So let's have a look at some examples based on real world current stock prices for Tesla. So when we're trading options, we've got to make the decision, what is the strike price? Now, the closer to the actual current price, the strike price, is the more expensive it's going to be, because the more likely that stock is to go there. Further away, the less likely, the cheaper it's going to be. If you've got a really, really far away strike price, you know, it's going to be cheaper. And the same with time, but inverse to time. So time, the further away or the longer you've got from here to expiry, the more chance it's got of getting there. And so it's going to be more expensive. Whereas if you go for a really short time window, the chance of it getting there are much, much slimmer. So it's going to be cheaper. So the most expensive options are going to be closer to the current price with a long, long time frame. The cheapest options are going to be with a short time frame and a really, really long, really far away from the current price, strike price. Okay, so the way to pick really our strike price is to look at the options. Say, okay, I look at the chart, should I say, and say, okay, let's do some analysis on it, how we normally decide, and say, you know what, we've been in this range for the last year. Tesla's been at 375, low of 250. I think if we start to break 250, there's going to be some really seriously bad news. So I think we'll probably touch 200, and that could then be your strike price. You don't want it too close. You don't want to be buying a put option at 250 because that might be too expensive. You don't want it too far away, because obviously too far away, even though it's going to be cheaper, the chance of it getting there is unlikely or less likely, and so you've got to weigh out the results. So let's say we picked a 200 December put, and we thought, okay, like I say, December, because we thought it was going to happen before the end of the year. Fine. So we go along and we look at the 200 December put quote, and it says the quote for that is $8.56. There'll be a bid and ask for it, but assume that's the ask and we can buy it at that, or we work the price and that's what we get. So we buy one of those, $8.56. That costs us $856. It's quite a lot, but it's quite a high price stock, and there's a lot of implied volatility in it. People think that Tesla is going to do something pretty hefty. So we buy that, we've got $856 risk. The good thing is, regardless of what happens, if the Tesla doubles, we don't lose any more than the cost we've the cost that we've paid for the options. Maybe you would be praying if you were naked short on Tesla and it started ripping. But anyway, the cost you've paid for the option is $856. That's the most you can lose, because obviously you've got the right to sell something at 200. Maybe if it's 1,000, it doesn't matter, it's just worthless. So that's the plus side of that. But downside is it's quite expensive. Where's your break even on that? Where have you got to be at December the 21st for you to make any money? Well, if it hits 200, has that got any value? The option's got no value because you've got the right to sell something that's currently at that price. There's no value to that. So you've lost all the premium you pay for that option, it's $8.56. So really, logically, your break-even point is going to be 200 minus your $8.56, $191, sorry, 44 cents. So anything less than that, you start making money. Anything up to that, you're losing money. So that's your break-even point, and your payoff is going to be that flat line. So you've got the flat line basically where you're losing $856, and then as you start to come down, and let's say that's now your This will be your strike price, and we pick 200. You know, break even point is going to be 191.44. That's your break even line there, $0. If we do that in dollars, that's minus $856 because that's what you've paid for it. And then anything else from that is going to be nice, juicy profit. Okay, so that seems okay, but obviously your break-even price has got to be quite low. And you've got to see that stock really get hammered. But if it went to say 150, you know, you're going to make a decent amount of money, aren't you? You're going to make your $5,000 on your put option minus what you've paid for it, a decent sum of money. So what about another option where we can take advantage, and a pun was intended by the way, where we can take advantage of the cost of these options and utilize that premium by selling an option? Well, we could sell a call option, but the big caveat, and we must stand here and understand the risk in this, is that if we're selling a call option, the risk truly is unlimited because we're on the other side of a contract. Call option contract says, hey, I want the right to buy something at that price at a specific point in time in the future. So the buyer of a 300 call option has the right to buy Tesla stock at $300 in December. If Tesla stock is $5,000, hypothetical example, we've seen stuff do this, not saying Tesla's going to, but say it does, and they've got the right to buy it at 300. Will they exercise it? Of course they will. $4,700 in that, multiplied by your 100. You don't even need to do the maths to know that's going to hurt if you're on the other side of that and you have got to deliver that. So bearing in mind, if you're selling a call option, you have unlimited risk. So you must have other risk management tools in place. And bearing in mind, you can't manage the risk completely. If that gaps up overnight, you're going to be stung, and you're going to be stung hard. So something to bear in mind. However, the flip side of that is you make money for not really being that right. Because if you sell that 300 call, at the moment, 300 call option is priced at $35. $35, which is $3,500. If someone is buying that off you, you're going to receive $3,500 and you've sold them that options contract. So that gives you a break-even price of $335 because your strike is 300. $35 is what you've received for it. So basically, if this stock stays between the range 335 and below, you are making money. Anything above that, you're starting to lose money. So let's say the stock stagnates and goes up a little bit, down a little bit, but expiry is exactly where it was. You weren't right, it didn't go lower. You still made $3,500 on the deal. So you still made a decent sum of money on the deal. Now, of course, that's the most you can make. Your risk is capped on that. So whilst you're very likely, or you're more likely than buying an option to make money, your risk is capped and your losses are unlimited because you're on the flip side of the deal if you're buying an option. So the best case scenario for you is that the price goes anywhere between 335 and zero, basically. If it goes down to zero, fine, the call option's worthless. At 335, you're okay, you're broken even, but anything below 300, you've made that full maximum profit. So that looks quite tempting, and of course, but the trouble is being quite close to the strike price, or being actually at the money, it's right on the current price, which is 300. You know, that's the most premium it's going to be. It's kind of anything else after that's going to have intrinsic value in it, or anything further away is going to be less. So you could kind of try and be clever and say, well, I'm bearish on Tesla, but I just don't want to be too exposed. And you might say, okay, well, I'll go higher up the chain, like a 400, a 500, even a $600, pay far less, get far less premium, but then the chances of it happening are far less as well. So you're more likely to make money, but you're going to make less money. So that's the decision to make that you've got if you're bearish on Tesla and you want to trade options. Number one is, do I want to buy a put or do I want to sell a call? Now, bearing in mind, again, just being cautious, that is super high risk, but it's just informative, guys. It's not a recommendation at all. Or if you buy a put, you've got to decide your strike price and your expiry date. And if you're selling a call, same thing as well. You've still got to decide what strike price you're going to do and your expiry date, but bearing in mind the risk with that. Unlimited profit on this one, limited profit, but an unlimited risk, but a good chance of success. Anyway, guys, that is Tesla option trading strategies if you're bearish on Tesla till the end of the year. And bearing in mind, this applies to whenever you're watching this video. If you're watching this video 2 years down the line, 4 years down the line, exactly the same concept applies. Who knows where that number's going to be? If you come back and watch a video and I'm talking about 300, let me know what it is now and say I'm here in 2022, whatever it may be, and we're currently at $2 or at $20,000. Who knows? That's trading. Keep risk managed, whatever you're up to, guys. See you later. Bye-bye.